Ladies and gentlemen, welcome to another episode of What's on Your Mind, and it's my pleasure this week to welcome back Raj Malhotra on the show, and also our new senior trading mentor at ITPM, Edward Shek. Now, Ed's had a very successful 25-year professional career trading at various investment banks and hedge funds, so we're very lucky to have him both at the Institute and, of course, participating in these What's on Your Mind episodes as well. So, Ed, welcome to ITPM and welcome to your first episode of What's on Your Mind.
Welcome, Ed.
It's a pleasure to be here. Hello, Raj.
So, I think, as per usual, this week we'll start with a bit of general market commentary from you guys if we can, drill down into some specifics later on. And Raj, do you want to kick things off for us today?
Yeah, sure. So, well, first of all, welcome, Ed, and glad to have you here. So, I'm going to talk about I'm going to talk a little bit about a theme that I hear, or really a comments that I hear constantly. And when people can't, the comment is, I can't understand why the market is so high. Why is the market so high when the economy's not doing so great? So remember this. I say this often. Remember this. It's not a stock market. It's a market of stocks. So when you look closer into the market, while certain sectors are clearly having trouble, there's a real bull market in certain sectors of the economy, and and these sectors happen to be the market leaders. For example, technology. We all know that. We can talk about how technology has been on a run for 10 years, but it probably will. This pandemic has continued to basically have our reliance on technology so much more than ever. So that's clearly in a bull market, and it will continue to stay that way as we continue to work at home, and we need connectivity and as the economies develop. The other one is healthcare. It's an obvious one that's been ripe for consolidation. Not to toot my own horn, but the last two What's on Your Minds, two stocks I talked about, where one was Teladoc, and one was Livongo, which I talked about last time, in terms of how the healthcare industry and the telehealth industry in particular is ripe for a big run here, given that the way that consumers and given consumers don't want to go to doctors as much, given that there's more technology of a disruption in that sector, and those stocks have actually emerged this morning as we're filming this. So, as I said, it's very important to know that there are certain sectors of the economy that are strong and are going to continue to stay strong, and there's certain ones that are weak. So keep that in mind as you look for pairs trades in this market.
Absolutely. And following on from that, if we just mention briefly big tech, as big tech makes new all-time highs, the conversations, and they're slightly lazy conversations, always kick up about whether this is a bubble, make comparisons to 1999. But just anecdotally, in 1999, Cisco was trading on 100 times, and Unilever and BAT's solid, mature companies were trading on 8 times. In today's market, Microsoft on 25 times, Facebook on 20 times, and you've got Unilever on BAT's and BAT's on 20 times. So it's completely dissimilar. And ultimately, the big question of whether you think big tech is expensive is whether you think a company like Microsoft that's coming up with continuous 20% revenue growth on 20 times is expensive and bubbly or not. And clearly the answer is probably no. Now, I'm not a stock market historian. I'm a trader, and so we keep it with the trading mentality. But there's one nice anecdote here. We've just had the big tech congressional hearings, and you sort of think, wow, is there any breakup risk? Now, I said I'm not a historian, but if you go back just a brief 109 years, for example, and come across Rockefeller and Standard Oil, when that was broken up, it was broken up into 6 companies with 6 sisters. They became 4, and we know them as Texaco, Mobil, Chevron, and Exxon. Within 18 months, the value of those 4 companies was greater than Standard Oil. So clearly, it's just noise. It's just conversation that you hear in the news wires. But ultimately, value will not be destroyed, certainly not in the medium to long term, by the company size or structure. So that was something. I mean, clearly, any breakup is political as much as anything else. So we don't have to worry about that for the time being. I mean, it really goes on from what Raj was saying about we're in a bull market in some sectors and a bear market in others. So tech is not super expensive. Equities are expensive relative to their history, but they're not expensive relative to other asset classes. But again, from a trading perspective, does it matter if we think the market's cheap or expensive? We've just got to focus on what we like and what's growing, and we short stuff that is clearly on the other side. Yeah. I spoke to a couple of long-only global fund managers in the last week trading out of London with a global mandate. The smartest people in the market are always fundamentally bearish. No one likes a liquidity-driven rally. No one likes it when fundamentals break down, and we can see the performance of some of the top hedge funds. The smartest people don't like this market, and that's fine. But ultimately, liquidity is 8 to 9 tenths of the law at the moment. Liquidity is there. The market leaders are in great shape and growing. So without going into any more detail about the market as a whole, equities are probably going to continue to perform well, certainly for the next 3 months. And then we get into the election, and then we'll have another look. Raj.
Yeah, no, you're absolutely right. Like when the hedge fund community who claims to be the smartest people always, they were saying how the dumb money, the Robinhood investors, are the ones bringing the market higher. Well, first of all, that's nonsense because the guys with $20 in their account are not moving the market higher. That's just, for you to say that, you're obviously not the smartest person in the room anymore. That's just pure fluency. It's another fact that it just shows that hedge funds have just missed this rally and are just talking out of the side of their mouth how stupid money is making them making it higher. Well, you know what? That's all I say in trading. There's only one way to keep score. So
exactly,
who's winning and who's losing? So
continue to talk about the structural challenges. Tariffs have been going down since 1947 and up until last year. Corporate tax rates have been going down for 30 years. So corporate profitability has never been higher in terms of percentage of GDP. Clearly, at some point, the bill has to be paid. So it's a fair assumption to say corporate tax rates are going to go up. But you can argue and discuss these for hours on end. But ultimately, if you're going to trade off the basis of these sort of general discussions, you're going to miss what's actually happening in the market with your eyes wide open.
Exactly. And interest rates are zero. So where else are you going to have yield?
Well, that brings us nicely into kind of the next section of discussion, which should be kind of what stocks or specific sectors do we want to look at, or are you guys looking at? Raj, do you want to kick things off there?
Sure. So I won't talk about healthcare today. So we'll thread that in tech. So there's a company I've been looking at it's kind of in tech, it's kind of in payment processing. So and I've been long this stock for a while, and I really think it's about to really break out, is StoneCo, STNE. It's payment processing. It's essentially it's the Square or PayPal of South America, or Alipay of Asia. As it's pretty clear, this is a proven business model worldwide. Going to a payment processing, going to paying with your phone, paying with basically not cash, is a business model that works everywhere. So why would it not work in South America? It's just a different name. But that's and speaking in terms of acquisitions, like why wouldn't this name be an acquisition candidate for one of those companies, a year from now? But before that, let me go through some of the numbers. Their revenues in 2018 was about 400 million. Last year they did 650 billion. They haven't really announced what they're going to do. They think they'll do this year. But my data says that I think their lowered expectation number was slightly higher than last year's, but I think it's going to be much more. They're reporting on August 25th. Right now, they're a $13 billion market cap. And right now, their consensus for Q2 is 12 cents a share. And their revenues are around 140 million. I wouldn't be surprised to see that's blown away. If you look in the past, their earnings per share was 57 cents last year. They're saying it should be somewhere between 58 and 70 cents this year. But if you look out a couple years, they're looking at a dollar and maybe like $1.26 out in 2 years from now. So again, it's hard to estimate what those revenues are going to, those earnings per share is going to be, but you can see the trend is pretty clear. And there's other reasons why I think these numbers might be like, which I'm about to go into right now. One thing that's another thing that I do like about that is in general, I think earnings, as the S&P has gotten to where it is now, people talk about Europe, but I do think emerging market valuations are actually pretty attractive here. I really do think that, and I think there's value in them as a whole. Obviously, Brazil is hopefully going to emerge. I wouldn't even call it an emerging market yet, but it's got a long way to go. But again, Brazil is South America's largest economy by far, and it's been reeling from the effects of COVID. According to the Central Bank of Brazil, economic activity shrank 14% from a year ago in May. But however, so all that being aside, and this is part of the reason I bought it aggressively after the last earnings call, which they missed. Like the rest of the world, while business traction has shrunk dramatically, the digital space is picking up all the slack, and that clearly is in favor of fintech in Brazil and digital payment platform StoneCo, which is by far the leader. The company just said that it handled 51% of all of Brazil's e-commerce transaction Q1 2020. So I would think that it would also be able to capture the rest of the Latin American market. It's the dominant force within the country on cashless payments front and the e-commerce. In e-commerce, if you look at the e-commerce as a whole, it's still just mid-single digit percentage of the retail spending. So think about that, how much of a growth market that is. Again, it's only like mid-single digits. So there's such a big. If you believe that people will start shopping online more in Brazil, like they have in every other country in the world, why wouldn't this company just benefit off that? And again, like we've talked about before, the pandemic changes things permanently. Once you start buying stuff online, like in Brazil, people aren't going to go back. So, and the other thing too is, as much of the digital payments have been a boon to the company's also started credit services and merchants on their platform. So I mean that does have some potential risk if these merchants start to default on loans, but their tech has actually helped vet who needs help and checks the availability of the customers to make payments based on their transaction history, which Stone already has, which is actually a pretty cool feature. So they basically are able to predict defaults, and they just don't extend them credit. So that's another and positive this company. And that's actually something that most banks don't have. So that's actually another piece of the puzzle that they could actually outsource or sell to banks and other vendors. So again, the valuation is pretty premium territory. But I mean, given the opportunity and the pole position in Brazil, this could be one of the dominant players in South America. And right now, the stock's below 50. It could easily be $100 or higher in a year from now. And like I said, like we talked about in terms of bull markets within sectors, when there's bull markets within sectors, there's consolidation in M&A activity. Just like you saw in healthcare this morning, would I be surprised to see one of these companies try to buy this? So PayPal or Stone become the Brazilian to take this South American market? Absolutely not. So structure-wise, I'm just looking at an October call spread. I paid $4.50 to make $13.50. It's a 3-to-1 payout in October. I don't think the consolidation is going to happen then, but I mean it could certainly go much higher before then. But that's an option structure I looked at, and in the company that I just don't see how the business model doesn't work.
Sure. Is that something that as well, all else being equal, you kind of consider rolling over further than that, or is that too distant to think about?
I mean, I'm long it for the short and the long term. So I think, yeah, absolutely. I would roll higher. But if you want to look at a pure option structure, just in the short term, the 3-to-1 payoff here is what I look at, and that does line up pretty well.
Cool. Ed, what about on your side? Have you looked at any longs?
Well, I've got one long for you. Blink Charging, BLNK. slightly out of the wheelhouse because we're in the microcap space. When I bought this initially, the market cap was $250 million. In the last couple of weeks, it's got up to 310, as high as 380, but we'll get to the price action in a bit. It's a very straightforward story to understand. I mean, Blink manufactures, sells and deploys electric vehicle charging stations. It has two revenue streams. It obviously manufactures and installs these with its partners, who they call property partners. And these may be garages, companies like Walmart, Macy's, Google, and we're going to come up to all the tie-up possibilities in the future. They also operate a Blink network, and this is a cloud-based services solution to both the property partners who own or where the charging stations are physically located. And it also has a Blink registration network for all the owners of electric vehicle cars who sign up to Blink. That gives them access to 23,000 stations. They can obviously use any of them. They get a slight discount on their charge price. So there are two revenue streams and only two KPIs, really, the number of stations purchased and deployed, and obviously their membership, which is currently at 180,000. The company is loss-making. It's got an aggressive road to 13 million stations by 2023. Now, clearly, the market's not pricing that in. It's got 23,000 at the moment. And we're going to mention that this sector has had many a false storm, and so the market is understandably skeptical. The product itself is best in class simply because it's got the fastest charging times. It's at the cutting edge of technology. It owns and operates the hardware, installation, and the software, so there's no upsell, no side sell, so margins are robust, and they're looking to double in the next 1 and 2 years. It also covers the residential market. You can buy a Blink charger on Amazon. They're very small, much smaller than the competition. They obviously look very pretty. You stick it up in your garage and you're charging. So they're best in class in a market that potentially has explosive growth. Now, just touching on the story, I mean, this stock was trading at $35 as recently as 4 years ago. The problem has been the slower than hoped for adoption of electric vehicles in general. We understand that this is a twofold issue. Firstly, not everyone can afford a Tesla, not everyone has a garage. There's been a lack of cheap and medium-priced electric vehicles for the masses. Now, whilst again, this is a 1, 2, 3, 4 year story, we know that all the major automotive car manufacturers are spending and investing heavily to come up with a product range that's really for the masses. So that's step one. Step two is the infrastructure. It's a chicken and egg. You know, when do you buy an electric car? Well, when they're reasonably priced, when they look okay, when I like it, and when I can see a charging station every 5 miles like you see a petrol station. So I think governments understand this. Obviously, thematically, electric cars are coming, and it's just a matter of how fast. But the government's spending far more on infrastructure. And so a lot of the money that Blink makes comes from government grants via states to improve the infrastructure. So these tailwinds are very much in place. It's an easy story to understand. It's all about timing. So you'll say, so why now? Well, the stock's been bubbling around at between $1 and $2 for a few years, and it suddenly started showing signs of life. And we got hold of this at $7. The reason why I felt the timing might be advantageous is this company makes a lot of announcements to the market in between earnings, averaging 3 to 4 a month. This has really accelerated in the last 2 months. So a couple of months ago, for example, it would announce that it's hired Brendan Jones to be its chief operating officer. He's a 25-year veteran, a heavyweight. He knows making cars. He knows making electric cars. He's worked for charging companies. He's well known, and that's positive. We've also seen directors buying the stock, which we always like, a couple of $1 million. That's positive. However, if you look in the last month, it's just announcing deal after deal. So in the last few weeks, it announced a tie-up with Virginia State. It's called the Virginia Clean Cities. So they get a contract to build 200, only 200 charging stations in the mid-Atlantic. Stock traded up 15%, traded 30 million shares compared to 5. It's a big move. Previously to that, a week before, it was increasing the network in Miami. Same story, up 10%, lots of volume. I think yesterday it tied up with a commercial real estate company. I think who are they called? They are called Cushman and Wakefield. And so they're marketing big products. They obviously have commercial tenants, commercial operations all around the country. And of course, that is just one company with one tie-up. And again, stock up 10%, trade 25 million. So we know the story. There is a massive uptick in activity of contracts. So I think if this continues to gather momentum, the upside could be very, very large. In terms of cash burn, the company burns for about 12 million a year. It's got 20 million on the balance sheet, so it's got about 1.5 years' money. In its memorandum and articles, it is set up to issue up to $20 million via equity at any point in time. I don't think this is a problem. I think the stock will trade well through these raisings because clearly all the investors are hoping it is well funded to take advantage of what will hopefully be spectacular growth. So in terms of the numbers, it's obviously a revenue story. The numbers are small. Revenue, 3 million, year zero. Going up 138% to 7, going up 80% the year ahead, in the second year, and then 70% out 2 years. But I mean, really, it's trading on 58 times revenue now. It'll be 20 times revenue next year and 10 times revenue 2 years out. But it's kind of nonsensical because if you buy this stock, you think that the rate of pickup of new clients of deployment is going to start growing exponentially. Margins are going up from 40 to 60% next year. There's clearly economies of scale, which we haven't even got into. So I think this stock could outperform enormously. Other anecdotal points of interest, short interest 10%. That's equivalent to 3 million shares of the stock that trades up to 20 a day on a news day. So it's not much short interest, which is kind of surprising. Sometimes you like a structural short because it's just latent demand at some point in the future. That said, the stock's rallied. Well, it traded as high as 13 last week. It's had a 40, 50% move, and there's not much short interest. It's not well covered by the street. So all these things we like. Is this for the Widow and Orphans Fund? Possibly not. It's a 320 million, market cap. We've seen this story before, the skeptics will say. It's a low price stock. The option chain has $2.50 increments. So your classic bull call ratio won't give you the best payout. So recommendations may be buy at the money or a $10 December. And you can layer it out at August at 12.5, September at 15. This will obviously cap your upside at about 37.5%. But obviously, with the volatility in the stock, and it's moving 10% up 10, down 5, up 12, it's that sort of quantum. This is a story for the long term, but you're going to have many trading opportunities and restructuring. So ultimately, like Raj's example, I want to be long for the long term. But there's plenty of good trading opportunities, and that's why I think it's interesting.
Awesome, that's a great story, and it's good to hear about something about a microcap as well. We haven't heard many of those on What's on Your Mind so far.
What's interesting, I thought one thing you said was interesting. You talk about Cushman Wakefield and how commercial real estate or office buildings, putting them in. I think that's one way to get millennials back to work, so they can take, because they're so cheap. We all know they spend all the time not tipping but worrying about what to be offended by. Maybe that'll get them into the office so they can take advantage of the electricity, and then they can spend more time on seeing what's the next thing to be offended.
Yeah, cool.
Okay, so on to the next one then. I think back to you, Raj. Do you have anything else you wanted to talk about?
Yeah, speaking of millennials being cheap and useless to move, one name that I really have had my eye on for a while that I really think was actually this I like to highlight a lot of times from one of an idea that comes from my students. This one came from her, so it's just a woman, so not a man, so women can do this too. But the a name that I had, and this is a name that a couple years ago I probably would have been bullish on, and I think it's changed. So keep that in mind. How the information changes, and what this name is Ulta Beauty, ULTA. It's a beauty retail superstore. Looking at their numbers, they this year they're no surprise their earnings growth is projected to be minus 65%. Next year they're expected to make 158% higher than this year. Actually, I'll give you the real numbers. Their gross numbers. EPS zero. They made $12.15 a share last year. This year they're saying they're going to make $4.32. Next year, $11.14. What's interesting to me than that is, if you forget about throw this year out as a outlier, the fact that they're actually expecting to make less in 2021 versus 2019 is just not a positive trend. And there's a lot of reasons why I believe that. So their market cap right now is about a little over 11 billion. They reported on August 27th. But the thing is that the thing that I had my eye on the stock is this has been a long-term downtrend in the stock price since July, even before any of this was even on anyone's radar. So, and I think, and the reasons are there are a few reasons why. So one is just the changing business of cosmetics in this country. Millennials. They're focusing a lot more on skincare rather than cosmetics. Cosmetics have kind of become somewhat of a commodity. If you're buying nail polish or fragrance, hair care products, you don't really need to try that on in the store. I mean, I know I buy all my hair products online, so I don't need to actually go in and physically try it on myself. But in terms of, they've been slow to the skincare adaptation, but they've been focused on cosmetics. And the way Ulta used to get you into the store was, to try all the products and have almost like a beauty playground. And that's obviously COVID is not happening this year. And it's one of those businesses. So we talked about in bear market, it may never come back. That's just as people shift the way that they buy things, such as, for example, obvious, which is online, there's less reasons for them to go into the store. And given like a lot of other retail businesses, the heavy real estate, the high rents, the employees have to pay. It just doesn't really pay anymore. And if you look at just the cosmetics industry as a whole, cosmetics made up for over 50% of their products, and they are in a structural decline right now, believe it or not. Millennials are just spending less on cosmetics. They think it's more natural beauty now, or whatever they think. But that's what it is. Another thing that's important, you really look down deep in the numbers, unemployment during the lockdown has impacted women more than men, and mostly young people. So that's obviously a headwind to them, and that's Ulta's primary demographic. And another, if you even look further, is Hispanic women are experiencing a steeper unemployment decline than other women during the lockdown. And according to a study that I read, Hispanic women are the foundation of the beauty industry. So they outpace their spend on cosmetics more than any other demographic. So if the demographic you're going for is most in a bear market, essentially, in terms of discretionary income, well, obviously we know where that's gonna how that's gonna play out. And again, it's they're gonna focus on what they buy, but in terms of buying new things, it's just not going to happen. And also, if you look, another trend is if you look during the lockdown, many beauty customers turned to do-it-yourself beauty services and products. So again, it's another way for them to save money. So all these are headwinds to the stock. I mean, obviously, the risk to this is, even with if a COVID vaccine comes, you'll probably get a rally in the stock. But I don't think that's going to last too long because of what has happened. There's a theory that the beauty business is always recession resistant. Now, that may have been true in the past, but I mean, are you going to really spend money on cosmetics if you're not going out? So you don't really need to spend your money on that. And honestly, you just spend less on that in general, just because you don't get made up. You put on Nike sweats and no makeup. And they've also been very slow to move their business online. And I think really most of their, like I said, most of their products are not exclusive to them. So you don't need to buy them on Ulta. You just buy them wherever they're cheapest. So I really think with all these headwinds, it's a stock that even with any good news, the upside is pretty capped, and it's really in a structural bear market. So in terms of structure, I put this on a while ago. I bought the SEP 200 150 put spread. I paid $12 for it, but I can still pay about $15 for it when I looked at it yesterday. And against that, I sold the August 180 puts for around $3 because the stock doesn't report until after August expiration. So if it stays, even if you put it on right now, if the stock stays above $180 before August expiration, which I think is pretty likely, just because there's not I don't think there's any impetus to really go down that much. You can spend $12 right now to make up to 38, which is still over a 3-to-1 payoff. And I just think that's a name that's, like I said, capped to the upside. And even though it's in beauty, it doesn't look that attractive to me right here.
All right, gents. So it was great to hear from you both this week. I think we'll wrap it up there. It's been a great episode. Lots to learn from your market commentary, and also a good insight into some of the kind of fundamentals of process in looking at individual stock ideas as well. So thanks for both of you contributing. Now, as for all of you guys watching, as always, I want to point you in the direction of our website, itpm.com, if you want to keep up with our news and our events that are coming up. Obviously, there's more information as well about our courses and mentoring, so all of that's up there. Do take a look. That's us done for this week's episode, though. I hope you guys all enjoyed the show, and make sure you join us in a couple of weeks' time for another episode of What's on Your Mind.